Hello,
Hello,
how are you?
I am good. Got work done on the car today. That's always fun, sitting
Ooh,
and waiting, doing nothing.
maybe not. What do you do in times where you just have to spend a lot of time doing nothing and waiting?
Trade.
Nice.
Yeah, I have
As
my
long as the
tap.
market's open, right?
Yeah, as long as well, if the market's not open, then I'm looking at futures or just kind of looking at different positions and seeing what's out there kind of for the future.
Oh, um,
It's been a great freaking week. I had like one of the best weeks I've had in a long time.
that's amazing. I say I'm so used to using Google Meets for work. There's like this button where it makes like confetti go all over the place. I'm like, I need that button too. That's awesome.
Yay! No, it's it's part of being like an active trader is it's very like cyclical and that like the the way that I trade, my positions are about like, 40, 50 days. So they kind of build in one direction or another. And as the market moves, you try to start off with a little bit of size. And then you kind of, as volatility increases, you build your position. So you're building into volatility and selling more and more premium. But usually as that's happening, the market's going against you. So you're taking losses, not really taking losses, but you're seeing marked losses in your account while the
Yeah, you're
market's going
incurring.
against you. Yeah. So it kind of has like this rubber band effect where you'll have a bunch of days where if the market's going against you, you're building positions, but you're also taking losses. And then usually what you see is a contraction and volatility happens. Typically, it happens pretty quickly. So
Mhm.
when you have good days, usually you have pretty good days. And that's kind of what happened. We've had about 4 weeks now where the market's just been kind of uncertain and expanding volatility. And then here over the last 2 or 3 days, it's kind of some of that fear is dissipated and that translates into premium coming out, which translates into good days and people are starting to put risk back on, which means the market's going up and like it's just an all around good thing if you're selling premium. So it's been a long time
You love
coming,
that.
about 4 weeks of just like up and down, then up, then down, then up, then down, but more down than
Yeah,
up.
yeah, I feel like we've just been kind of going sideways for a little bit and just not
Absolutely.
really choosing a direction, which I guess in the case of options, it's good if you did a covered call because you don't really want it to go anywhere, but otherwise, not that great if you're trying to trade and want it to move us in a certain direction. Um, I
Yeah,
did
this
have one
is,
question.
go ahead.
So, on my plug position, today is the last day, and I
I
was
thought
going to roll it out,
I thought next week was your
but
last day.
nope, today.
Oh,
So
cool.
today my covered call expires, and it was a $27 call for whatever. And my question is, it did hit 27 today, but like, does it really make sense for anyone to buy it? No, right? Because if
No, the
it's
way that
at
it's
the
gonna
same
work,
price,
yeah, the way that it's gonna work is at the very close of business. That's all. The only thing that matters is that last price at, well, I shouldn't say the only thing that matters is the last price at 4 o'clock because the stock can actually move after hours. But if
yeah,
it's like 20 cents or like more below 27 like it is now, it's about 15 cents below 27. So you're probably going to still have a little bit of value in that contract. Yeah, it's worth 13 cents right now, 14 cents.
yeah,
And it's going to maintain that value to some degree all the way up until 4 o'clock because the stock can actually move after hours after the market closes. And
correct.
and because of that reason, it's still going to maintain a little bit of value, probably even up until the close. So you've got kind of two options. You can pay probably by the close. If we're still trading right here, it might be like 3 cents, 2 cents, maybe even 1 cent. And you can pay that and buy it back, or you can just let it expire.
Yeah.
What I like to I have a margin account, and I don't know what type of account that you have, so I can sell naked options. So if I get into a position like this, where it looks like
Hmm.
it's going to be really close by the end of the day, what I'll do is just let it expire, but I'll also go out in time and sell another contract against it. So like I'd go out to
Oh,
whatever
but I
30
would need a
days.
margin account
But
to
yeah,
be able to do
you're
that.
technically, if you're doing that, you're getting naked a contract, so you can't
Right,
do it
because your other
without
one hasn't
it
expired.
hasn't expired yet. But when you have a
Okay.
margin account, you can do that. Like if I see that the stock is like a week away from expiration, and I feel like it's not going to get there, I'll get that little boost in extra premium for those 5 days and sell another
Mm.
contract against the same shares just to kind of give myself a little bit more opportunity. But if you don't have a margin account, they won't let you get naked in a position. So you have to either wait till it expires or buy it back and roll it out.
Okay.
It's like a
That
mental
makes sense.
game for me because like I think of the weekend as a two day period where premium is coming out because typically premium does come out over the weekend, but it doesn't just like it's not like you wake up on Monday and premiums come out. Sometimes it comes out Thursday, sometimes it comes out Friday, sometimes it comes out um, Monday, sometimes it doesn't come out at all, and sometimes it's just kind of spread out over those days. So you never really know when they're going to hit that premium for the weekend, but usually there are times where if you have multiple positions on, you can absolutely see the weekend premium coming out on like a Thursday or a Friday or a Monday, and you can see that value in your account coming out of your options. So
Mm.
having seen that, I know that the weekend is a factor in trading because of the fact that it's 2 days where people don't get the opportunity to trade, but those that time still passes out of your contracts. So that's why I like
Right.
to sell in advance if I think it's not going to hit my strike. But but yeah, at the end of the day, you can do nothing. You can sell another contract. You can maybe you'll get called away. It could rally another 20 cents. You never know. If it's above
But
27.01,
like,
you'll more than likely be called away.
okay, that's good to know. But
Yeah.
can I ask why? Like, if it's basically at the strike price, like, does it make
Well,
it
most
does?
brokerage firms will default to anything a penny or more in the money will automatically default to exercise or assign
Oh,
or
okay, that's
exercise.
good to know.
Yeah, so the brokerage firms will automatically do it if you don't tell them otherwise. Most of them will, um, just to make sure that you're not letting contracts that are worth like $10 expire and you're not exercising them. So they automatically do it for you. Um, for the brokerage firms that don't do it for you, if it's like 2 cents in the money, for some people it does you might not always get assigned. I've had option contracts that were much more than 2 cents in the money not get assigned, and it was just an oversight. It was a mistake and the person missed out on money and it worked out in my favor, but it very rarely happens. I trade thousands of times a year, and I think it's happened to me one time.
Okay.
So it's
So if I
very
want
very
to keep
rare.
my shares, I should buy back my contract and then sell another one.
Yeah, but you can wait until the end of the day. I mean, if you look at it in term of if you look at it in if you look at it in terms of time,
Oh, wait,
sorry,
wait, wait,
you
wait.
can't now.
Yes.
Okay. Um, if you look at it in terms of you collected what, like 170 bucks,
Mm-hmm.
but that was for like 30 days. And now the 30
Yeah.
days has passed and now it's still worth like 15 bucks. So in proportion to the amount of time that you have left to wait compared to the amount of time that it cost you to make that $155 already, this is the most valuable portion of the time because literally in less than 4 hours you're going to make another $15 out of this contract. Whereas it took you
Mm,
30 days to make the other 155.
that
Does
makes
that make
sense.
sense?
Yes, it does.
So it's not a bad thing. If you've waited this long, it's not a bad thing to wait to the end of the day. Worst case scenario, it you know, there really isn't a worst case scenario the stock crashes, but it's not a bad thing to wait to the end of the day. And then
Yeah. Cool.
so you're kind of limited as to which strikes you want to choose. You have to go to the weeklies if you want to maintain your 27 strike.
But so now, but do I have? I don't have to maintain a 27 strike.
No, you don't have to at all. You basically the stock paid you $170 and you still have the stock. That's all that happened.
Yeah,
It's the greatest thing in the world.
and I won't get called away. Hopefully.
Yeah.
Well, I won't if I buy
It's
it back. Yeah.
it's literally like you rented your stock out to somebody for the month. You Airbnb'd your stock.
I know, and I don't even have to own any Airbnbs because,
Ex-
to be honest,
exactly.
fun fact,
And you
on
can
one
do it
hand, I'm like,
again for the next month.
well, that's exactly what we're gonna do. Um, okay, so I
Did you
think
say fun fact what?
oh yeah, I was just gonna say, like, on one hand, I'm like, there's a part of me that's like, oh, it'd be really nice to like own a property that I could Airbnb. But on the other hand, I'm like, with the climate changes, I'm like, well, it's either gonna have an earthquake or it might get flooded or something other crazy, and I'm like, maybe I'll just wait or buy it in a different location.
Well, you've got where do you want it? And
I was thinking about buying, well, I can't really afford much in the US, but I was thinking about buying a cabin in Norway because climate-wise, a little bit safer than other places. Just
have you ever had like a rental property or anything?
no, we're just gonna give it to a management property, but I would want to have like be able to go visit.
It's not a bad investment. I just sold one of my rental properties and I held it for a little over 10 years. I had this one that I just sold, and it literally paid for itself for 10 years. I got all the
Wow.
equity out of it, sold it for more than I bought it for. Like everything about it was, and I had a property management company handle it because it's out of state. So like I literally it was hands off, cash flowed, and appreciated, and somebody else paid for a nice chunk of cash that it's like a win-win-win situation. It's like
Yeah,
you really can't. It's not. I don't want to say you can't go wrong. We had
I mean,
a nightmare of a property management company before the one that we had now, who literally up and absconded with thousands of dollars, like just of our money, tens and hundreds of thousands of dollars of like all of the properties that he managed. He literally just fell off the face of the earth and thought that he could take all this money and it was a Remax company. Come to find out, he lost his Remax affiliation like 6 months before and didn't tell anybody. And he had been still
I didn't know
operating under, yeah, it was the most shady thing I've ever seen in my life. He got sued by all kinds of people, got in trouble with the Texas Real Estate Commission, all kinds of fines, and like, but then he went and wrote a book.
people do
You
that.
can't make this, you can't make it up. He wrote a book and started another company. Didn't go to jail, got fined and had to pay back some of the money, but I never saw a dime of any of it because I was just so sick of it that I was like, just get me away from this terrible individual, and I don't want to have anything to do with any. It wasn't like it was that much money. It was like probably like 3 or 4 grand by the time everything was said and done. So I was just ready to move on to something else. But like he had hundreds of properties that he just kept all the rent, security deposits, everything, and and
Okay, so due
left the
diligence
city.
on property management company.
It was a nightmare. I'd never even in my wildest dreams did I think that that was something that could happen.
I mean, I have heard of property management companies not being great, but I haven't heard of them doing that. And
Yeah,
like my parents have had tenants that like were horrific. We had one lady that like just took buckets of water and poured them on the like on the floor until it raised, and then she was like the floor wasn't right, and we were like, well, you're pouring water on the floor, and she was like, but it should maintain, and we're like, wait a minute, like why are you doing that? So yeah,
I give that
definitely like I've
example
heard some.
as a horror story, but in the long run, in the like that's just one property, and
Yeah.
in the overall, in the grand scheme of things, I've had great tenants and properties, and it's 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 a good investment if you want something that's tangible. It's a little bit more work unless you want to pay somebody to do it. I've done the property management side and I've done my own management of them. I like my own management of them more because you make more money, but I like the
Yeah.
property management side because it's hands off and you don't have to worry about anything. So it's either
Yeah.
way you do it, you really can't go wrong as long as you're not like putting all your eggs in one basket. If you're going to do one property, it's a good place to start, but ideally you'd probably want a couple of different properties just so you don't if you got one property and something goes really badly, then that's just a bad day. Or if you've got a couple and
Yeah.
something goes badly with one of them, it's like okay, you still have cash
You have
flow
the other
coming
one.
in and everything.
Yeah.
But it's a good
Also,
business to get into.
I just like to be well-rounded, so we would like to eventually have a few and just have, all things considered. Also, someone asked, what are the three best financial indicators on TradingView? Interesting.
Mm,
Let
um,
me look at which ones I use.
yeah, I don't use a
Also,
lot
do
of
you use
trading.
TradingView?
No, I don't use, well, I have used TradingView. Um, I actually like Koyfin better.
Boyfriend.
Yeah, I think
Interesting.
it's Koyfin. And I like it because you can aggregate charts on top of one another and look at industries and sectors in conjunction with one another and see how they're doing relative to one another. And that's more of the style that I trade. I don't trade off of like relative strength index or anything or MACD. I don't use those type of indicators. Really, the only thing that I have as an indicator on my platform on Thinkorswim is the volatility, and that just gives me a kind of a level of where IV is charted out. I have the
Interesting.
default, I guess, the moving averages set up in there by default as well, but I don't put a lot
Yeah,
of
same.
credence in them.
Um, I do as like a monitoring. I don't do it as like a hard and fast, like these are the guidelines I always go by and trade with, but more so like I do use stochastic, but again, not religiously. It's more of just like one of many indicators I like to have, and definitely like support and resistance lines. Where like if let's say we're trending upwards over the course of like weeks, then like if anything is going to break that trend, like I would want to have an alert to know that, okay, like the stock has broken the trend and now what the trend is reversing. So I like to do it that way. And I like that TradingView lets me put like draw a line and then basically will continue just running until it breaks whatever line you drew, which I think is cool. So you don't actually have to be like, oh, at $24 or at 30, it'll just like keep to the line. And when it crosses it, it'll just alert you, which I like.
Yeah, that's cool. I mean, I know that like the platform that I use, I know you can set stuff up like that. I've never been like a real big technical trader. I played around with it, and it's cool. I mean, especially if you trade like that, there's so many tools out there that are powerful to use. I just don't trade like that, so it's hard for me to I don't know. It's hard for me to comment on all that kind of stuff because
That's okay.
most of it just
Um,
is.
can we go through a spread again today? Because I want to make sure I understand it.
Yeah, yeah, yeah. Did you look at before we do that? Did you look at what strike if you want to roll out in time? Have you looked at what strike that you want to roll out to? You said
No,
you were thinking
because
about changing.
I got locked out of my Robinhood account. Because
Oh no.
I tried to, well, not in like, they didn't like lock me completely out, but because I'm in Sweden, my phone is set to airplane mode. And so I can't get like any automated messages because you need data for that. So
Gotcha.
I will do that later. But I was looking at it earlier and it looked like I think November 5th were the ones that looked the best. My thinking though now though, depending on like the broader trend, actually this is what I want to look at. Depending on the broader trend of plug, like I would be more inclined to basically roll out to a higher price because if it is, well, I guess it's still trading within that channel.
Yeah, it seems to be holding.
Yeah,
It's
it's not
gone down
really
and
doing
tested
anything.
120, or it's gone down and tested 24 three separate times.
Yeah.
And each time it bounced kind of off of that 24 level. You can, I'm looking at it now, the 30 strike is trading for about 85 cents or 85 bucks. That gives you a lot more
Well,
upside potential. And
for which date?
that date that you said, the 5th,
The 5th?
and the 28 is trading for, see, here's something that if you could see your platform, and I don't know that Robinhood shows it in this fashion. I think they just show you a price, don't they, for the contract? They don't show you the bid and the ask, or do they show you both?
They first they show you the price and then once you click into it, they'll show you the bid and the ask.
Okay.
Also, not my brother. Someone
We're
asked if you're my brother.
brothers from another mother.
Yeah, we can do that.
Um, One of the things that you're going to notice when you look at this expiration is the
Hmm.
markets are wide. So between the bid and the ask on the 29 strike, there's almost there's 30 cents between those bid and the ask. That's a wide market for a stock that's this price. And then there's another over 30 cents between the 28 or on the 28 strike. There's more than
Hmm.
30 cents. So that's something to take into consideration when you're putting on trades. You can also look at the open interest
What
and
is
the
that?
volume.
Can you put what wide or not wide market? Can you put that into context in terms of like
Um,
if it's a good thing, bad thing?
oh, yeah. So wide markets is you've got buyers looking to pay something and you've got sellers wanting to be paid something. Buyers want the bid or want to pay the bid, sellers want to be paid the ask. So the difference between them is referred to as the bid ask spread. And the wider the spread, it just means that that's more room for both the buyer and seller to have to come together in order to agree on a price. And kind of like stock, you've probably heard the term slippage before, or
No.
crypto. So slippage is the money that you're giving up when you're going to put on a trade, getting in the trade and getting out of the trade, because the buyer and seller ultimately have to agree on a price. And when the markets are a penny wide, meaning the bid is 100 cents and the ask is 101 cents, then one person basically is giving up $1 to get in and out of that trade. So round
Yes.
trip, looking at a maximum of probably $2 that you might end up giving up out of the trade to get in and out. But when they're 30 cents wide, you might be giving up a nickel because that you might, in order to get filled, you might have to give up a nickel worth of value or even a dime, which is $5 or $10, getting in and getting out. So the wider the markets, the more money you lose, the more expensive the transaction ends up being for you because there isn't enough liquidity there. There's not enough interest in those strikes or that expiration cycle that you can get in and out easily. And if there's not enough people there, it ends up being a cost to you in the long run. It doesn't seem like much when you're just looking at it in terms of one trade or $5 or but when you're talking over time, if you're giving up $5 every time you do it coming and going, that's $10 per trade, and you put this trade on, 10 times a year, that's $100 that you're giving up unnecessarily because of wide markets.
Okay, yeah, that makes sense.
So basically you're paying, or you're only getting $5 less every time you sell, and when you go to buy it back, you have to pay $5 more with a
Right,
wide
because
spread.
there's that spread.
Yeah.
That that
And
makes sense.
it's just also, it's usually an indication of liquidity. The more liquid the markets, the narrower that spread is. Like if you were to look at Apple or even the SPY, you'll notice that because there's such huge products and there's so much volume in there, the spreads are usually like a penny or 2 pennies wide because there's just tons of money flowing and there's interest in all of the strikes and there's a lot of people trading it. But the weekly option contracts in a product like this, it's got good liquidity. It's a good trading vehicle. It's traded 10 million shares today. But the weekly contracts are always going to be um, less liquid than the monthly as a general rule of thumb, unless there's like an earnings or something going on. Sometimes you'll get good liquidity in the weeklies for an earnings event. Um, but when you go to the monthlies, if you look at the 30 strike, it's 131 bid against 135. So they're 4 cents wide in the monthlies. So the bid-ask spread is almost 10 times less in the monthly expiration because there's so much more interest in the monthly expirations.
On
However,
average, is it just because more people trade monthlies, like generally
yeah,
as a rule of
yeah,
thumb?
that's exactly why it is. There's a lot more people trading those, like on your platform. Let me see if I can throw open interest onto my platform here. I don't think I have it set up. Intrinsic low option.
So in, but it's not like in stocks where when you would still be able to sell a contract even though the bid and the ask are
Yeah,
wide, correct? It's not like
absolutely.
in
Yeah.
stocks where like, oh, I want to sell it at, I don't know, let's call it 27, but there's not enough interest in the market, therefore like you might not be able to get filled at that price. Options are
Well,
not like that.
no, it is like that. You might not be able to get filled at the price that you want. That's what I mean when I say you have to give up and you have to pay up. You have to pay up and give up. So when you're getting out, you
Uh,
have to pay up, meaning you have to pay somebody else
okay,
more to take the other side of your trade. And when you're getting in, you have to give up some of your credit that you're taking in. So that's exactly what it
okay, so it
is.
is the same. Okay,
So like
okay,
what
that makes
just
sense.
to give you an example, I've added open interest to my options chain. In the 30 strikes in the monthly cycle, there's about 6,000 contracts out there. Open interest means how many contracts are currently open in that cycle. When we go back
Yeah.
to the November 5th cycle, there's 500. So there's a tenth of the volume of contracts or people interested in trading and actively trading in that cycle. It's not a terrible thing. It's just something to keep in mind. And it makes sense that the bid-ask spread is so much wider in that cycle because
For
it's a tenth of the interest. There's a tenth of the attention and volume flowing through those cycles. So that completely makes sense why the spreads would be wider.
okay, I think that makes sense.
So
I
that's just a, like general rules of thumb type thing to keep an eye on is as an indication of liquidity. And you always want liquidity is extremely important when you're trading options.
but then, well, yes, because you want to be able to be filled at the price that you're looking for. But then in the case of a spread, is that, are you then just like, can we go through that? Because that's different than the bid ask spread.
Yeah, yeah, that's a different
Okay,
spread that's talked about. Um,
okay,
and actually, liquidity isn't as big of a deal in a spread as it is because you have two sides to the transaction. So it's typically a little easier to get mid price when you're putting on a spread than it is with a naked option. Like I feel like if you have an illiquid product and you absolutely want to trade it, it's usually better to put a spread on. I think anyway. And
Okay.
I'm just looking at the November 12th expiration cycle, which is just 1 week further out. It's 35 days away instead of 28. Um, the 28 strike in the November 12th has a ton of open interest. There's 5,000 contracts. It's still a weekly, um, and the spread is significantly more narrow if if you want to get like integral and still be able to do, not have to do the 30 or the 25. The 28 strike has a ton of open interest in that cycle. So a spread
Yeah.
is, I guess, give
Is
give me an
it
example of what type of opinion you want to express, and then we'll go from there. As far as, do you have a particular stock that you are interested in trading?
not right this minute? No, but is it, well, something very liquid, right? That should be, or like, can we first put in like qualifiers of types of stocks that would be good for spreads, or just options in general, like high liquidity would be one.
Yeah, high liquidity. Well, high liquidity and high implied volatility are usually always good if you're doing anything out of the money, meaning you want a high probability trade. The more implied volatility that you have, the further away from the price of the stock you can get and still give
Yes.
yourself a reasonable amount of credit for the risk. So it lets you get your
Yes.
risk further away with more volatility than you otherwise could with less volatility. So volatility is good when you're putting a spread on, as a general rule. So a stock like,
Can we
um,
do pen?
yeah, we'll do Penn. I think Penn is probably a little less liquid than something like DraftKings, but let me look. I don't usually
Or
trade
we can
Penn.
do Facebook. Facebook has been very volatile this week. And yes, it definitely went down because of the outages this week. And
Yeah,
because
that
of
was a
all the whistleblower stuff.
yeah.
I
Actually,
mean,
Penn is pretty liquid. Penn's pretty liquid, and Facebook is always liquid. Either one of those would work.
yeah, okay.
So, do you have an opinion um, about either of those stocks? Longer term, nearer term?
Let's see. Well, so yeah, we do it every week on Fridays. Um, my opinion is that so far we have kind of started the reversal, but it could still come back down.
Are you looking at Facebook or
So,
Penn?
10.
Okay. So you're seeing
And
this.
if anyone else has an opinion, feel free to
So you're
chime in.
seeing this kind of this $65 range as kind of a bottom, is what you're thinking.
Yeah.
Because I'm looking at the 6 month chart, just to kind
Yes,
of get context,
exactly. Yeah, I'm looking
and
at
I
the
see it.
weekly.
It's basically like a triple bottom there at 65, where
Yep.
it bounced off that 3 times, and then it's since rallied, kind of come back down, and it's now bouncing off the 73 times, pretty
Yep.
much.
Yeah,
So
exactly.
if you wanted to express a neutral to bullish position in there, um, I would I would be looking to sell a put spread. And when you use, just kind of definitionally, if you're using the term sell, all that means is your short is more valuable than your long. So the one that you're selling is giving you more credit than your long is costing. If you're doing it the other way, you'd be buying the spread. So when you sell a spread, you're taking in money. When you buy a spread, you're paying money to put it on. And you can actually express the same exact opinion with the same exact risk profile by
on the
either,
opposite side.
yeah. So it's kind of irrelevant.
Wait,
As,
sorry, I want to make sure A, I write that down, and B, I understand fully. So when you want to do a neutral to bullish position, you said we're going to sell puts.
yeah. So if you're selling a put spread, well, selling a put in general is bullish. It means you're willing to buy the stock at that price.
Yes.
So, so in order for that contract to expire worthless, the stock price has to be above it. So when you sell a put spread, you're still selling that put, but you're just buying protection below the put in case the stock falls through your put strike. You don't want to take on the full risk of the value of the stock. So you're defining your risk amount to whatever chunk of exposure you want.
Okay.
So
And then
something like,
can you re-explain the short value is greater than the long value? Can we go through that like one more time?
yeah, yeah. So like just definitionally to refer to the trade when you're talking about selling anything, you're receiving a credit. So in order to receive a credit, the thing that you're selling has to be more expensive than the thing that you're buying.
Yes.
Does that, so that's
Yeah.
that's why it's referred to as selling a spread as opposed to buying a spread. Even though you're doing both selling and buying, in both instances, when you buy a spread, you still have to sell something and buy something. When you sell a spread, you're still selling something and buying something. The only differentiating factor is the net result of a debit or credit to your account. So when you have to pay out to get into a spread, it's referred to as buying the spread. When you receive money for getting into a spread, it's referred to as selling a spread or shorting a spread or longing a spread. I mean, all the terms are just like interchangeably, and there's so many terms that fly around. It's kind of, or people say I'm long this, and they might actually be short a put spread. So you can get
And
long
this
a
is the one
stock.
thing that drives me crazy. It's like, can't we just all agree on like the four terms that we're gonna use? And we're like, no,
Yeah, you can get
we're
long, and
not.
that's how I get long things is by getting short a put. I get long by getting short.
Okay, so long equals getting into position.
Long is yes, long is means buy something, have a bullish opinion. Um, yeah, those two things. It usually means you're
Okay.
either going to buy something or you have a bullish opinion or a bullish position. It can mean either of
So
those
being
things.
short something is a downtrend opinion.
Well, being short something means you either sold something or you have a bearish opinion or a bearish position.
Okay, that makes sense. Ish. Just nomenclature. Um,
Yeah, you would think they would have like one term or like one meaning for the term long and short. It really is kind of confusing. After you've done it for a while, it just becomes kind of second nature. You do have to clarify though when someone says I'm long or I'm short or but when in this example to get long the stock, I would give myself room to be wrong. We've already kind of established that we think that there's a level of support at around the $65 mark where it's bounced off that and tested it 3 times. And
okay.
that support goes back 6 months. So for me, I'm going to actually put this trade on right now. I'm going to collect $105 and it's going to cost me about $400 to sell the 65 and buy the 60.
So,
And that's the cool thing about options is the market is so fair that once a stock meets your criteria, I don't have a problem putting this trade on, even though I just looked at the stock 2 minutes ago. Like to me,
oh,
that's a perfectly fine trade.
but in this instance, you don't own Penn shares, right?
No,
This is a naked. Okay.
no, it's not naked because you're defining your risk. Naked refers to taking the entire risk of the
Oh, just
stock in
one.
one direction. So
Okay.
my maximum risk in this trade is $395 because I'm collecting $105 and it's $5 wide. Now, in a perfect world, when like with these monthly expirations in pen, they're $5 wide, so you don't have a lot of options as far as strikes to choose from. In a perfect
Yeah.
world, I would try to get somewhere around a third of the width of the spread, the $5 or $500. So I would ideally be looking for closer to 150 to 170 in credit in a perfect world where I could choose my strikes if I'm going $5 wide. So one third of the width of the spread is a general rule of thumb as a good place to start. If you're looking to put on a directional play, you think the volatility is good, you think the liquidity is there, and I just got filled in it. You think the volatility is good, the liquidity is there, um, then that's a good place to start. You're not always going to get that, but that can kind of be the make it or break it for the trade. In this example, if they had better strikes, I would have taken in probably closer to $150 on a $1 wide or a $5 wide,
Hmm.
but they just don't have the strikes there. So
Okay.
for me, because we're doing this and because it's a small directional trade, that's cool. I don't mind putting it on for a little bit less than I normally would because everything else about the strike or the stock is good. There's okay volatility and it's liquid, and directionally I'm also kind of bullish with Penn and both with DraftKings. I've had a bullish sentiment on them for the last year or two. So yeah, that's just how simple it is to put a trade on. Once you get the mechanics down, you get so comfortable with it that literally that's the time it takes me to assess a trade and place the trade. Just what we did. And even faster after you've done it for a while. Because the market's
So,
fair. It's going to pay you a fair amount for the risk you're taking.
can we also define both of the top end and the both sides of it? So, like you're saying you will sell the 65 and then buy the 60. So, are you saying that
Correct.
you're willing to buy the shares if they hit 60 and
Uh,
you're willing
well,
to sh
I'm saying that I'm willing to buy the shares at 65, but I want an insurance policy that gives me the right to sell back out of them at 60. So the difference between those two contracts is $106. I have to buy the shares at 65. But if the crap hits the fan and the stock falls to 20, I can turn around and sell those shares to the person that I purchased the contract for at $60. So I'm really only losing $5 and I still get to keep my credit of 100. So I'm really only losing $4 or $400. That's what's happening. You're guaranteeing to buy them at 65 and you're buying an insurance policy to get back out of them $5
if
away
it
from
falls
that point.
below 60?
Yeah.
Okay.
So how it would look on expiration, if it's below 60, I'm going to take a maximum loss of $395. That's the most I can lose in this trade. If it's between 60 and 65, however high above 60 it is, I'll lose that much less than 395. Does that make sense? So if it ends
Say
at
that one more time.
60, so however high above that 60 or my long strike is, I'll lose that much less than the 395. So if it's $1 above or at 61, then instead of losing 395, I'd lose 295. So it wouldn't be a full loss, but I would still lose in the trade. If it's at 62, I would lose 195. If it's at 63, I would lose 95. If it's at 64, I would make $5. So my break even on this trade is $63.95.
Because of the credit that you're collecting.
Yep. The break even is just your short strike less the credit. So you take the credit
Yeah.
and basically add it on to whatever direction, and that's your break even. So now here's a that's just called a vertical put spread. You can do the same thing on the other side and sell a vertical call spread. So that's if you wanted to get bearish the stock. And that's just going to make money in the same exact fashion. It's going to behave exactly the same, but it's going to, instead of agreeing to buy the stock, you're agreeing to sell the stock at a certain price. So let's say we agree to sell the stock at 90, but we also want to have a protection at 95. So that would give us the right then, the contract that we are buying at 95 gives us the right to buy the stock at 95. So if you have to go out and buy something for 95 and then turn around and sell it for 90, you lose $5, but you keep the credit.
So if you're selling the stock at 90, would you then be buying a call? Selling a call?
You're selling a call. Yep, you're agreeing to sell it,
Selling
just
a
like you
call.
do with a covered call. You see how knowing what a covered call is comes into
Yeah.
handy when you're building spreads now because you understand.
So on the so on the 90 you're selling a call and then right? And then on the 95 you're buying the
You're
call?
buying that you're buying that call to define your risk again. So you're buying that insurance
Okay.
policy to define your risk. And that insurance policy gives you the right to buy the shares at 95. So if you get blown out to the upside, you can go out and buy the shares with the contract that you own at $95. You still have to turn around and sell those shares at 90, so you lose $5. You keep your credit and your loss is the difference. But here's the thing. You can only lose to one side, right? Stock can only be.
Yeah, because you have protection on the other.
Well, yeah. Well, not only that, you're taking in money on both sides of the market. So remember, we're looking at this now call spread, and this one's going to give us this spread that I am looking at right here is going to give us $50. And I'm actually going to move my strikes. I'm going to move my strikes to 85 and 90 just to take in more of a credit. And I'm going to take in $82. But the principle is exactly the same. Oh, it looks like I was filled on that already. So I sold the 85 and bought the 90.
Okay.
$5 wide. Principle is exactly the same. I mean, as far as everything that we've
Yeah.
talked about, I just brought it closer to the money. So now I've taken in another, what did I take in? I took in I took in 106 on the downside for my put spread, and I took in 83 on the upside for my call spread. And that's what's referred to as an iron condor. Because I can only lose to one side, meaning the stock can only be above, I mean, it can be both above 85 and below 65. It can only be either above, you can only lose to one direction at the end of the day. So what that does is now gives me another $83 in credit to add on to my break even to both sides. So instead of having a break even of 395 now, my break even to the downside is increased by $83. Does that make sense? Because if I lose to the
Kind of.
downside, I win to the upside.
Okay.
And if I lose to the upside, I win to the downside because you're selling both sides of the market. So you're just giving yourself a range of profitability in between your two short spreads. Am I making sense?
Kind of. I think I need to simmer on this and like review it. But it kind of is starting to click a little bit.
think of it in terms, don't think of it as spreads. Just think of it in terms of naked options. If you sell a call, you're agreeing to sell shares at that price. If you sell a put,
Yeah.
you're agreeing to buy shares at that price. So if you go out to the 60 and you sell that 60, you need the stock to stay above 60. If you go out and you
Yeah.
sell the 90 call, you need the stock to stay below 90.
Moment.
You're
Right.
doing exactly the same thing,
Yeah, so you're
but you're just
creating the range in
defining,
which.
yeah, you're just defining your
Okay.
risk. And you're also reducing by selling both sides of the market because you can only lose to one side. You're reducing your overall risk in the trade. So I went from having a max loss of 400 or $395 and I reduced that max loss by $83 because I sold the other side. So it doesn't matter now which side I lose to. If I get a max loss, the max loss is closer
It'll
to a
be
$300 loss than a $400 loss.
$400. Okay. I think that's starting to click.
But for everything that the market gives you, it takes something away. So in this case, it gave me a smaller maximum amount that I can lose. But what it took away from me is the ability for the stock to rally into perpetuity and be profitable. So I gave up directionally. Now I can lose to both
Y-
sides as opposed to only losing to one side.
Right, because yeah, in either direction you have set your boundaries basically.
Correct.
Okay.
But I got something in return for that, but I
Right.
gave something
A
up as well.
credit.
Yeah,
Yes. Yeah, so you're basically like defining, well, spread of the basically the like ceiling and the floor, and then you're willing to play within that for credit in exchange for basically defining what those barriers are.
exactly. Exactly.
Cool. Right,
That's
I
it.
get
That's
it.
just how simple a spread is. I mean, there's more that goes into like picking the stocks that you want to trade and I like to get long into weakness. So like if a stock is weak, that's when I like to get long into that stock and sell into that weakness of the market, and I like to get short into the strength of the market. So there's other different styles that come into it, but that's that's all options are. I mean, you're just combining. I mean, there's more different types of spreads and different combinations, but you saw how easily we took one spread and combined it with another spread to create a completely different expression of an opinion within the market.
Yeah.
And you can do
Can
that in a
we, for our next one for next week, could we do one where we define like another expression that is different? And then can we also actually, I'll take screenshots once I get into my Robinhood, but um, I feel like it would be helpful to also go through like the interface because I think one of the things that I found slightly confusing is that as the market, as you're getting closer and time is expiring, the numbers on the contract keep changing, even though technically what your personal contract was still is held to the numbers that you put on when you sold the contract or bought the contract. So can we
Yeah,
go
no,
through that next time?
yeah, absolutely. Let's do like
Okay.
there's a way that you can actually so like if you host because I'm normally in my car driving when we do this. But if you
Okay.
host, what's that? Oh, I'm not driving
Okay.
now. No, 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 I'm not driving right
Okay.
now. I'm parked now, but I'm saying I'm normally on the road when we do this. So
Okay.
I won't have like a computer, but if you host, I can like send a guest request, and I think it pops me up in like a little box on the bottom right of your screen, and it'll give a larger screen that I'll be able to see your screen, and we can walk through exactly like what you're looking
Yeah,
at,
let
and
me.
I think it'll be easier to understand if you can see it visually. Absolutely, for sure.
Okay.
It's a
Awesome.
really
That sounds
difficult
good.
thing to understand just talking about it without being able to see it. It really is.
Yeah. Yeah. So we can do that next time.
All
Thank
right.
you.
Yeah,
Have a good
absolutely.
weekend.
You as well. Take care. Thanks,
And
guys.
everybody else. Bye.